Gold and silver are setting up to embarrass every safe portfolio in 2026. The funniest part is the market is still trying to explain it away like it's just a headline trade. You can feel the pushback already. It's too high. It's overbought. It's just fear. But that dismissal is exactly why the next leg can be so violent. Because the pressure isn't emotional right now. It's structural. And if you stick with me, I'm going to give you the one hidden detail that keeps telling the truth, even when the price tries to fake you out. Plus the two levels that decide whether this becomes a controlled retest or a continuation squeeze that gaps while everyone is still waiting for a better entry. Let's start with what the tape is actually saying today. Not what people wish it was saying. Gold isn't creeping. It's stepping. It's been trading in the mid 4,500s to upper 4,600s recently, with flashes even higher. And it's doing it with that specific kind of behavior you only get when liquidity thins and the market stops offering you clean pullbacks. Silver, meanwhile, has been ripping around the high 80s into the 90s per ounce zone, and it's not moving like a sleepy precious metal anymore. It's moving like a hybrid asset that's part currency hedge, part industrial input, and part positioning grenade. And that blend is exactly where the real pressure starts, because everyone's looking at the candle. But the signal is underneath the candle. It's in the plumbing, it's in the curve, the spreads, the availability, and the way participants are forced to manage risk when deliverable supply tightens at the exact moment portfolios and hedges are being reset for a new year. And that calendar detail matters more than people admit, because January is when narratives get rewritten, allocations get rebalanced, hedges get rolled, and the market is still thin enough that big flows don't politely wait for the crowd to process them. That's not drama, that's mechanics. Here's the conflict you're watching play out in real time. The mainstream story wants this to be a simple safe haven pop that fades when the news cycle calms down. The market structure story says something else. Once the system starts sniffing out tightness, the futures market can't just decide to relax. It has to clear. It has to find the price where the marginal seller appears. And when sellers don't show up in the right place, the system does what it always does. It changes the terms, it changes the spread, and eventually it changes the price. But that's not even the punchline yet. The hidden detail is this. In metals, there's plenty of supply is a meaningless statement if that supply isn't available in the form the market can actually deliver when the contract clock starts. This is where people get hypnotized by the wrong totals. They'll quote above ground stock, they'll quote inventory like it's one bucket. They'll say, there's tons of metal out there. Sure, somewhere. The question is, how much is ready, registered, deliverable, and economically rational to move at today's terms? Because if the market has to pay up in the nearby months to pull metal forward, that shows up in the curve. And once that happens, you're no longer trading a story. You're trading a constraint. And constraints don't care about opinions. So let's make this simple without turning it into a conspiracy comic book. Futures are a promise. Physical is a thing. They usually track because arbitrage and confidence keep them connected. But when the market gets tight, the difference between paper price and physical availability stops being academic. The market starts paying for time. It starts paying for certainty. It starts paying for immediate delivery. And that's where spreads start screaming, even if the headline price looks fine. And when spreads start screaming, somebody gets forced to act. But that's not the part most viewers are watching, and that's why they get blindsided. In a typical calm market, the curve is boring. The near month trades near spot. The forward months are slightly higher because of financing, storage, and carry. That's contango. It's normal. It's sleepy. But when the nearby months get bid up relative to the back months, or when the tightness shows up as unusual firmness in the front end, it's the market telling you, if you want the metal now, you're paying extra. That condition can show up as backwardation, or it can show up as a curve that simply refuses to relax even when the price dips. The exact label matters less than the message. The message is urgency, and urgency changes behavior. Because when the front end tightens, refiners and fabricators can't just shrug. If you're an industrial buyer and you need silver for production, you don't care about someone's macro thesis. You care about your line running. If you're a jeweler, a mint, an electronics manufacturer, or anyone whose business depends on metal arriving on time, you start paying attention to premiums, lead times, and procurement risk. And that's when you see the real-world symptom. The market may quote you a price, but the metal may not show up at that price in the quantity you need, on the schedule you need. And that's where the paper market gets vetoed by the supply chain. Now zoom into silver specifically, because silver is where this gets spicy. Silver is not just poor man's gold. It is a byproduct, heavy metal. A lot of supply comes as a secondary output of mining other metals. Now that means you don't get a clean ramp when price rises. You don't just flip a switch and create supply next quarter. Refining, processing, and logistics are real. Lead times are real. Recycling has limits too. It doesn't magically surge because Twitter got bullish. So when industrial pull increases, whether that's from electrification, solar, electronics, or broader manufacturing cycles, silver can develop a supply tension that doesn't resolve on the schedule traders want. And when that tension meets a financial bid, it can turn into reflexivity. Price rises, availability tightens, procurement accelerates, hedges get adjusted, and the bid feeds itself. But the next detail is what flips the whole setup: the calendar. This is the why now trigger that most people ignore because it sounds boring until it costs them money. Early in the year, you get portfolio rebalancing, fresh inflows, and systematic strategies resetting exposures. You also get futures rolls and option positioning shifting as the market moves from one expiration window into the next. In metals, those windows matter because delivery cycles matter. Option expiry matters because gamma matters. And when price is moving fast, the hedging flows from options can become their own engine. Let me translate that without making your eyes glaze over. Dealers who sell options often hedge dynamically. If the market is rising and there's a lot of call exposure, hedgers may have to buy into strength to stay neutral. That's delta hedging. The important part is what it forces them to do. If you get into certain zones where gamma is high, small moves can trigger outsized hedging flows. That's how you get that it just won't stop tape. And that's why certain price levels act like doors. Above them, the math changes. Below them, the pressure eases. It's not mystical, it's risk management. Now layer in positioning. In precious metals, there's always a crowd that tries to fade rallies. Sometimes they're right, sometimes they get vaporized. When gold and silver trend higher, shorts don't just lose money on paper, they face margin, they face risk limits. They face the uncomfortable reality that in a fast market, liquidity disappears when you need it most. So the act of covering can become fuel, not because of a grand plot, because the risk manager doesn't care about your thesis. The risk manager cares about the account surviving the week, and that's where the forced buying starts. So you've got three engines that can stack: physical tightness, signaling through spreads, industrial procurement refusing to wait, and financial positioning getting squeezed by options and margin dynamics. That's your mechanism stack. And now we add the fourth engine: institutions that buy gold for reasons that are not price sensitive in the way retail expects. Central banks do not buy gold because it looks cool on a chart. They buy it because it reduces dependency. It reduces counterparty risk. It hedges against settlement stress. It is one of the few reserves that doesn't require another entity as promised to pay. And in a world where geopolitics, sanctions risk, and reserve politics are part of the landscape, that demand becomes strategic. Strategic demand is sticky. Sticky demand doesn't vanish because the RSI is high. And that S, why every time the market thinks it can bully gold lower on a rates are up headline, the dip gets absorbed in a way that feels unfair. But that's not the part that matters. The part that matters is the second wave: private institutional flows. ETFs and ETPs are often dismissed as dumb money in a wrapper, but that's lazy. They are a pipeline. When flows come in, metal has to be sourced. When flows reverse, metal can be released. Either way, it's real enough to affect availability and psychology, and the reflexivity is real. Inflows push price, higher price pulls attention pulls more inflows, and suddenly what was a quiet allocation becomes a public trade. If that pipeline starts running at the same time as the curve is tight, you get the kind of move that doesn't ask permission. And if that one level breaks, the math changes. Now the macro layer, because I know the audience watching this isn't here for fairy tales. You want drivers, you want mechanisms, you want to know why 2026 specifically has a plausible shot at outperformance versus all markets, not just a bounce. Think about the macro regime we're living in. Debt loads are heavy, fiscal policy is loud. The market keeps oscillating between tight policy forever and cuts are coming, and that oscillation creates a problem: credibility. When real yields rise aggressively, metals can stall. When the market starts pricing easing, or when the currency starts wobbling, metals behave like a pressure valve. Not because the world ends, because portfolios rebalance around purchasing power risk. And if the market begins to suspect that policy will choose financial stability over crushing inflation at any cost, gold doesn't need a panic to perform. It just needs the opportunity cost narrative to weaken at the margin. And that's where the real pressure starts again. There's also an uncomfortable truth people avoid. Even if inflation comes down in the headlines, the distributional impact of higher costs, higher debt service, and geopolitical fragmentation can keep uncertainty elevated. Uncertainty is a bid. It shows up in hedging. It shows up in allocations. It shows up in the desire to own assets that dawn a T rely on smooth functioning of every institution. That doesn't mean you bet the farm. It means you respect why the bid exists. And then there's the global arbitrage layer, the part that makes precious metals feel like they have their own gravity. When one region experiences stronger physical demand, tighter supply, or higher premiums, arbitrage doesn't ask for permission. Metal flows toward the highest netback. Pricing gets pulled across borders. And if logistics or regulations slow the flow, the premium persists longer than traders expect. That SY you pay us will sometimes see the international price look reasonable, while the on-the-ground price feels like a different asset. That divergence is not a curiosity. It's a signal. It's the market telling you physical is doing its own negotiation. And the next detail is what flips the whole setup from bullish to potentially violent. Inventory categories. This is where people get tricked. Warehouses and reported inventories often have multiple buckets. Some is eligible, some is registered, some is deliverable, some is not readily deliverable without someone choosing to convert it. And that choice is economic. If converting or delivering exposes the holder to risk, or if they can earn more elsewhere, they won't do it just to make the futures curve neat for you. So the market can look well supplied in aggregate, while the deliverable portion is tight. That's the deliverable illusion. And when the illusion breaks, the market doesn't politely adjust. It reprices fast. Now, does that mean price only goes up? No. And if you're serious about building trust with a finance-minded audience, you name the exits. Here are the clean ways this thesis can break, at least temporarily. 1. A sustained surge in real yields, not just a one-day spike, but a trend that increases the opportunity cost of holding metals and crushes speculative positioning. 2. A strong, sustained dollar rally that tightens global financial conditions and forces liquidation across risk assets, including metals, at least in the short run. 3. A sudden easing of geopolitical risk combined with stronger growth and tighter policy credibility. Basically the environment where gold and silver don't need to be owned as insurance. The market believes it. Those are real counterpoints. You don't ignore them. You monitor them. Because price can whip around violently even if your longer-term thesis is correct. That's the whole game in metals. Trend signal versus noise. So how do you navigate that without getting emotionally manipulated? Because you will be manipulated, not by a villain in a back room, by volatility itself. Volatility is the market's way of shaking out weak hands and forcing bad decisions. It makes smart people chase tops, sell bottoms, and then swear off the trade right before the next move. The psychology trap is simple. A fast rally triggers FOMO, then a sharp pullback triggers panic, and the brain confuses discomfort with danger. Your job is to separate discomfort from invalidation. Here's the rule of thumb I want you to internalize. If the underlying structural signals stay intact, if the curve stays firm, if physical tightness signs persist, if flows remain supportive, then a pullback is not a verdict, it's a test. The market tests conviction. But if the structural signals roll over, if spreads loosen, if front-end urgency fades, if flows reverse sharply, then you treat it differently. That's risk management. That's how you stop letting the tape bully you. Now let's get concrete, because I promised payoff, not poetry. Over the next week or two, you need a checklist, not predictions. A checklist. First, watch whether gold holds above the most recent breakout zone. Think in terms of the mid-4500s area as a psychological shelf. If gold can't hold its higher range and starts living below that shelf, it signals the market is rejecting the higher pricing for now, not forever, but for now. Second, watch silver's behavior around its recent highs in the low to mid-90s region. Silver is notorious for false breaks. It will poke above a level, suck in momentum, then snap back. The confirmation is not the first break. It's the ability to retest and hold. Because if that one level breaks and holds, the math changes. Shorts get trapped, hedges get adjusted, and the market can gap on thin liquidity. Third, watch the gold-silver ratio behavior, not as a magic number, but as a tell for which metal is leading. When silver leads aggressively, it often signals a risk-on industrial bid plus speculative fuel, and that can turbocharge moves. When gold leads, while silver lags, it can signal a more pure monetary hedge environment, neither as good or bad. It tells you what kind of market you're in and what kind of volatility to expect. And that's where the real pressure starts for anyone who treats silver like a sleepy asset. It's not sleepy. Fourth, watch the dollar and real yields, but watch them with humility. In this regime, correlations can flip. There are periods where gold rallies, even with yields rising, because the market is not trading the level of yields, it's trading the meaning of yields, credibility, sustainability, and financial stability risk. If you see yields rising because growth is strong and policy is credible, that can be headwind. If you see yields rising because term premium is rising and debt dynamics are loud, that can be tailwind. Same data, different story. And the market will tell you which story it believes by how gold reacts on the day. Fifth, watch options dynamics around key expirations. You don't need to be an options quant to respect the effect. If price grinds up into an expiration window and then accelerates, that's often hedging flow. If price stalls exactly where the crowd thinks it should and then snaps, that's often positioning getting reset. Either way, don't get hypnotized by the first move. Watch the reaction after. The reaction is the truth, but that's not the part most people watch. Now let's talk about set to outperform all markets in 2026, because that's a big claim, and it deserves a finance-grade explanation. Outperformance doesn't mean a straight line. It doesn't mean no drawdowns. It means the risk-adjusted story improves relative to other assets. In an environment where equities may be fighting valuation gravity, where bonds may be fighting inflation, uncertainty, and term premium, and where cash may be quietly losing purchasing power, precious metals can offer a different return driver. Not earnings, not coupon. A repricing of monetary credibility and supply constraints. If that repricing intensifies, metals can outperform because they're not competing on the same scorecard. That's why they can look expensive and still be underowned. Because they're insurance that turns into momentum. And momentum attracts capital, and capital attracts more momentum. Reflexivity is real. But the next detail is what flips it from nice rally to structural re-rate. The supply chain veto in silver and the reserve diversification bid in gold happen in parallel. Gold can be pulled by sovereign and institutional behavior. Silver can be pulled by industry and scarcity of flexible supply. When both are pulled at the same time, the market's usual relief valves, mine ramp, easy recycling surge, casual selling, don't respond fast enough. The only thing that can respond instantly is price, and price is a weapon. It rations demand. It pulls supply forward. It forces hedges. It forces liquidation. It forces capitulation. And that's why these moves feel unfair, because they're not negotiated, they're enforced. Now here's the part where people get themselves hurt. They confuse conviction with leverage. Don't do that. If you want to be on the right side of a structural theme, you respect that metals can whip around violently even when you're right on the big picture. The market loves to punish certainty. The better posture is scenario thinking. 2 scenarios, simple lens, high credibility. Scenario 1, controlled pullback and retest. In this scenario, gold and silver cool off, price drifts back toward the breakout shelves. The crowd declares the rally over, and then the market checks whether physical and flow signals remain firm. If the curve stays supported, if demand remains sticky, if pullbacks get bought without spreads collapsing, that's constructive. That's how trends build. It's boring. It's healthy. It's also where most people get shaken out because it feels like nothing is happening right before the next leg. The confirmation here is higher lows and stability in the underlying structure. The invalidation is a deeper breakdown that coincides with loosening tightness and flows reversing. Scenario 2, continuation squeeze with gap risk. In this scenario, price holds above key shelves, liquidity stays thin, options hedging accelerates, and shorts, or underallocated funds, get forced to chase. This is where silver can behave like it's possessed. You see air pockets, you see gaps, you see intraday moves that make people swear off the market. The confirmation here is not just a spike, it's follow-through and the inability to push it back below the breakout zones. The invalidation here is a violent rejection that breaks the shelf and stays below it, signaling that the squeeze exhausted and the market is resetting. Notice how both scenarios can coexist with the same long-term theme. That's the point. You stop thinking in absolutes and you start thinking in flows and constraints. That's how you stay sane. Now let's talk about what to watch next at a more tactical level, because this is where your advantage lives as a retail investor with a brain. Big institutions often have mandates. They have rebalancing schedules, they have risk limits, they have committees. You don't. You can be patient. You can wait for confirmation. You can choose sizing that lets you survive noise. That is a superpower if you use it. So watch the market's behavior around those key shelves I mentioned. Watch whether pullbacks get bought quickly or whether they drift lower like gravity returns. Watch whether silver's strength persists relative to gold or fades. Watch the dollar reaction function. Watch yields. And most importantly, watch whether the market is paying for immediacy in the way it prices time, spreads, front-end firmness, and the general feel of availability and urgency. Because if the market keeps paying for time, it's telling you the constraint is real. And constraints are the kind of thing that can carry a theme through an entire year. That's why people who only trade headlines get left behind. They'll wait for a perfect news catalyst. The market already has one. It's the calendar, the curve, and the forced behavior of participants. The rest is just the narrative catching up. Now, I'm not going to pretend this is risk-free. There are always moments where the market uses volatility like a club. You'll get a day where gold drops hard on some sudden hawkish repricing. I'll get a day where silver dumps because someone got margin called in something else and sold what they could. That doesn't automatically invalidate anything. It tells you about liquidity and leverage. It tells you where the weak hands are. It tells you what kind of market you're in. But it will test you emotionally, and that's the point. The market will try to make you betray your own plan. So build your plan around what invalidates the thesis, not what scares you. If gold breaks below the shelf and stays there while the curve loosens and flows reverse, that's an invalidation signal. If silver loses its reclaimed levels and starts making lower lows while industrial and physical tightness signs fade, that's a warning. If instead you get pullbacks that hold and then the market reaccelerates, that's confirmation. You don't need prophecy, you need rules. Now let me give you the one metric everyone must watch it without pretending it as a single magic number. It's the relationship between the nearby demand signal and the broader price trend. Basically, whether urgency persists when price wobbles. If the market keeps showing you that the front end is supported, that time is being bid, that availability isn't effortlessly improving, then the thesis has legs. Because it means the bid isn't just speculative, it's functional. And functional demand is the kind that can keep grinding even when sentiment flips. That's the hidden detail that reframes everything. In metals, the curve often tells you the truth before the headline price does. And here's the social layer that people underestimate. When gold makes new highs, it attracts attention. When silver starts moving like a high beta version of that trade, it attracts a crowd. Crowds create feedback loops. Media calls it mania. Risk desks call it flow. Either way, it means volatility expands. In expanded volatility, the winners are the people who planned sizing and time horizon before the move, not during the move. If you try to improvise in a fast tape, you become liquidity for someone else. That's not an insult, that's how markets work. So if you were watching this and you were skeptical, which you should be, your job isn't to argue with the chart. Your job is to demand mechanisms, demand proof stacks. Here's the proof stack in plain language. 1, the tape is trending with urgency. 2, the market structure can show tightness through the curve and spreads. 3, silver's supply chain doesn't ramp on demand and can get vetoed by refining and byproduct realities. 4, central bank behavior in gold can be strategic and sticky. 5, ETF and institutional flows can turn a slow bid into a reflexive move. 6, options and positioning can create forced buying that accelerates price. 7, global arbitrage and premiums can keep pressure on even when the headline narrative changes. That's not one argument, that's a layered system. And layered systems don't reverse just because a talking head says overbought. Now, the final payoff, targets, invalidation, and next week checklist, clean, simple, usable. For gold, the target path is continuation toward the upper end of its recent range, and then a push toward fresh highs if the shelf holds. The invalidation is a sustained breakback below the most recent breakout shelf in the mid-4500s, combined with a visible cooling of urgency and flows. For silver, the target path is a push and hold through the low to mid-90s zone with the potential to overshoot in a squeeze, because silver overshoots when it's crowded. The invalidation is a failure that breaks back below reclaimed levels and stays there, signaling the move was more squeeze than structure. Next week checklist. Watch the reaction to pullbacks, not the pullbacks. Watch whether strength is sold quickly or absorbed. Watch whether the dollar and yields move and how metals respond. Reaction function matters. Watch the option window behavior. Does the market pin and then break, or does it grind and then accelerate? Watch whether silver continues to outperform gold on strength days. And watch for the telltale sign of a market that can't get relief. Dips that don't feel satisfying because bids keep showing up. That's where the real pressure starts. And if you've made it this far, you're already doing the thing that actually matters in markets. You're thinking in mechanisms, not memes. That's the whole identity here. Skeptical, but not blind. Curious, but not gullible. If you want to be part of the crowd that doesn't get emotionally farmed by volatility, stick close to that process. Share this with the one friend who always gets shaken out on the dip and then pretends they never liked metals anyway. And whatever you do, don't let a fast tape trick you into believing the move is over just because it got loud. Loud is often the beginning, not the end.